Greetings. In today's video we will discuss about a book called The Little Book of Common Sense Investing by John C. Bogle. After we run through summary and detail by chapter, we will have a look at the key takeaways. And stay with me till the end of video for bonus fun facts. The Little Book of Common Sense Investing by John C. Bogle is a renowned investment guide that emphasizes the importance of passive investing and offers practical advice on building wealth in the stock market. The book begins by challenging the common notion that active investing, where investors try to outperform the market by frequently buying and selling stocks, is the best approach. Bogle argues that this active approach is often futile and counterproductive, primarily due to the high costs involved in trading and the difficulty of consistently beating the market over the long term. Instead, Bogle promotes the concept of passive investing, which involves investing in low-cost index funds that aim to replicate the performance of a specific market index, such as the S&P 500. He highlights the benefits of index funds, such as their low fees, broad market diversification, and simplicity. Bogle argues that by owning a diverse portfolio of index funds, investors can capture the overall returns of the market, rather than trying to outperform it. Throughout the book, Bogle presents statistical evidence and historical data to support his claims about the superiority of passive investing. He also discusses the impact of costs, taxes, and time horizons on investment returns. Bogle advocates for a long-term approach to investing, emphasizing the importance of patience and discipline in weathering market fluctuations. Furthermore, Bogle addresses common misconceptions about investing and warns against the pitfalls of speculation, market timing, and excessive trading. He stresses the importance of focusing on long-term investment goals, maintaining a diversified portfolio, and resisting the temptation to chase short-term gains. In summary, The Little Book of Common Sense Investing is a concise and accessible guide that promotes the principles of passive investing as a sensible and effective strategy for individual investors. Bogle's book serves as a reminder to investors to keep costs low, diversify their portfolios, and stay the course over the long term to maximize their chances of financial success. Now here's a breakdown of the chapters in The Little Book of Common Sense Investing. Chapter 1. Rational Exuberance. In this chapter, Bogle introduces the concept of rational exuberance, which refers to the belief that investors can consistently beat the market through active investing. He challenges this notion and presents evidence showing that active investing is often unsuccessful due to high costs and the difficulty of consistently outperforming the market. Chapter 2. Casting Light on the Shadows. Bogle discusses the hidden costs associated with active investing, such as brokerage fees, transaction costs, and taxes. He emphasizes the importance of understanding and minimizing these costs to maximize investment returns. Chapter 3. The Grand Illusion. Bogle examines the illusion of superior fund selection, debunking the idea that investors can consistently pick winning mutual funds. He presents data on the inconsistency of fund performance and highlights the long-term impact of high expenses on investment returns. Chapter 4. The Exchange-Traded Fund. This chapter introduces the concept of exchange-traded funds, ETFs, as a type of index fund that can be bought and sold on the stock exchange. Bogle explains the benefits of ETFs, such as low costs, tax efficiency, and diversification. Chapter 5. The Silent Revolution. Bogle discusses the rise of indexing and passive investing, highlighting the growing popularity of index funds and the shift away from active management. He presents arguments in favor of passive investing based on its long-term performance and simplicity. Chapter 6. Dividends and Their Discontents. Bogle explores the role of dividends in investing and challenges the notion that high dividend yields are always desirable. He presents evidence showing that focusing on dividends alone can lead to suboptimal investment strategies and highlights the importance of total return. Chapter 7. Do you have the right stuff? Bogle encourages readers to assess their own investment behavior and mindset. He discusses the importance of self-awareness, discipline, and avoiding emotional decision-making in the pursuit of successful investing. Chapter 8. Selecting Long-Term Winners. Bogle emphasizes the importance of taking a long-term perspective when investing. He discusses the pitfalls of market timing, stock picking, and chasing short-term trends, urging investors to focus on broad market diversification and consistent investment contributions. Chapter 9. Tomorrow's Tyranny. Bogle warns against the potential dangers of excessive speculation and short-term trading. He discusses the impact of speculative behavior on market volatility and the importance of long-term investing for stability and growth. Chapter 10. The Telltale Chart. Bogle concludes the book by presenting a chart that shows the impact of compounding and the long-term benefits of low-cost index fund investing. He reiterates the key principles of common sense investing and encourages readers to embrace these principles for long-term financial success. Overall, each chapter of the book builds upon the idea that passive investing through low-cost index funds is a rational and effective strategy for individual investors, and it provides practical advice and evidence to support this approach. Here are some key takeaways from The Little Book of Common Sense Investing. 1. Passive investing through low-cost index funds is a sound strategy. The book strongly advocates for the benefits of passive investing, where investors aim to capture the overall returns of the market through low-cost index funds. It argues that this approach is often more effective than active investing, which involves trying to outperform the market through frequent buying and selling of stocks. 2. Costs matter. Bogle emphasizes the importance of minimizing investment costs. High expenses, such as brokerage fees, fund management fees, and taxes, can significantly eat into investment returns over time. By focusing on low-cost index funds, investors can reduce expenses and increase their net returns. 3. Diversification is crucial. The book stresses the importance of diversifying investment portfolios to reduce risk. Index funds provide broad market diversification, allowing investors to spread their investments across different companies and sectors. This helps to mitigate the impact of individual stock performance and enhances overall portfolio stability. 4. Long-term perspective is key. Bogle emphasizes the value of taking a long-term view when it comes to investing. He discourages market timing and short-term speculation, instead advocating for consistent investment contributions and a patient approach. By maintaining a long-term investment horizon, investors can benefit from the power of compounding and ride out market fluctuations. 5. Avoid common pitfalls. Bogle cautions against common investing pitfalls, such as chasing hot stocks, engaging in market timing, and overtrading. He advises investors to focus on their long-term goals, resist the temptation of short-term gains, and stay disciplined in their investment approach. 6. Understand the limitations of active management. The book challenges the idea that active managers can consistently outperform the market. Bogle presents evidence showing that many actively managed funds underperform their benchmarks after accounting for costs. He encourages investors to be skeptical of claims of superior fund selection and instead opt for passive index funds. 7. Stay the course. The book encourages investors to stay committed to their investment strategy, even during periods of market volatility or downturns. Bogle emphasizes the importance of patience, discipline, and resisting the urge to make emotional investment decisions. Consistency and sticking to a well-thought-out plan can yield favorable long-term results. Overall, the key takeaways from the book revolve around the benefits of passive investing, keeping costs low, maintaining a diversified portfolio, and adopting a long-term perspective. It promotes a common-sense approach to investing that focuses on steady, consistent growth rather than attempting to time the market or beat it through active trading. Here are some fun facts about The Little Book of Common Sense Investing, and its author, John C. Bogle. The Little Book of Common Sense Investing was first published in 2007. It quickly gained popularity and became a bestseller, known for its straightforward and accessible style of explaining investment concepts. The author, John C. Bogle, was the founder of the Vanguard Group, one of the world's largest investment management companies. He is often referred to as the father of index investing for his pioneering work in popularizing index funds. Bogle was a strong advocate for individual investors and sought to provide them with low-cost investment options. He was known for his commitment to putting the interests of investors first and for his passion for promoting long-term, low-cost, and disciplined investing. Bogle's ideas and principles had a profound impact on the investment industry. His philosophy of passive investing and index funds challenged the traditional active management approach and sparked a shift toward lower-cost investment options. Bogle was a vocal critic of excessive fees in the mutual fund industry. He believed that high fees erode investors' returns and argued for greater transparency and fairness in the financial industry. Throughout his career, Bogle emphasized the importance of aligning the interests of investment managers with those of investors. He believed that investment managers should be focused on delivering value to their clients rather than pursuing their own short-term gains. Bogle received numerous awards and recognition for his contributions to the investment field, including the Lifetime Achievement Award from the Mutual Fund Industry Awards and being named one of Time magazine's 100 Most Influential People. Bogle wrote several other books on investing and personal finance, including Common Sense on Mutual Funds, and The Clash of the Cultures, Investment versus Speculation. Sadly, John C. Bogle passed away on January 16, 2019, but his legacy as a champion of the individual investor and advocate for low-cost, passive investing continues to influence the investment community. These fun facts shed light on the significance of The Little Book of Common Sense Investing, and the impact of John C. Bogle's contributions to the investment world. Thank you for watching this video. Hope you find it useful to develop better you better me. If you like this video, please like and subscribe, and don't forget to check my other videos.